What if I told you there's a tax-advantaged investment account that's better than your 401k, better than your Roth IRA, and possibly the most powerful wealth building tool in your retirement arsenal? Yet about 9 in 10 Americans who have one aren't using it correctly. According to recent research, 88% of HSA holders leave their money in cash rather than investing it. Even worse, most wealthy investors completely overlook this option, potentially leaving hundreds of thousands of dollars on the table. Hi, I'm Mark Fonville, CFP and CEO of Covenant Wealth Advisors. For over 15 years, we've helped successful families with $1 million or more in investable assets retire with confidence and clarity. And today I'm going to reveal what might be the most underutilized tax strategy in America. Now, if you have a high income, substantial retirement savings, and are concerned about healthcare costs eating away at your wealth, you'll want to stay until the end. I'll show you how this overlooked account could potentially save you over $100,000 in taxes during retirement and help protect the legacy you've worked so hard to build. I'll also reveal the critical mistake that even my wealthiest clients almost made before we stepped in. So let me ask you something. When you hear health savings account or HSA, what comes to mind? Medical expenses, a simple way to pay for doctor visits with pre-tax dollars? If that's all you're thinking, you're missing out on what could be the most powerful tax advantage in your entire financial plan. Here's why. An HSA offers what I call the triple tax advantage, a benefit you won't find with any other retirement account. First, your contributions are tax deductible, reducing your current tax bill. Second, any growth inside the account, dividends, interest, capital gains, is completely tax-free. And third, this is the big one, qualified withdrawals for medical expenses are 100% tax-free. Not tax-deferred like your 401k or traditional IRA, tax-free. Though it's worth noting that non-medical withdrawals after age 65 are merely tax-deferred like a traditional IRA, they're taxed as ordinary income without penalty. Let's put this in perspective. With a traditional 401k or IRA, you get tax-deductible contributions, but you'll pay ordinary income taxes on every dollar you withdraw in retirement. With the Roth IRA, you pay taxes up front, but withdrawals in retirement are tax-free. But only an HSA gives you both tax-deductible contributions and tax-free withdrawals. It's essentially combining the best features of both traditional and Roth accounts. But here's where most people get it wrong. They treat their HSA like a checking account, depositing money and immediately spending it on current medical expenses. This is a massive strategic error for high net worth individuals. If you're watching this video, chances are you have the financial resources to pay for your current healthcare costs out of pocket. And that creates a remarkable opportunity that many financial advisors rarely discuss. Let me tell you about Thomas and Eleanor, a fictional couple in their late 50s. They had done exceptionally well, building a $3.2 million portfolio across various accounts. They were diligent savers and had been contributing to their HSA for years. But when I reviewed their financial picture, I noticed something concerning. Their HSA balance was only about $8,000 despite years of contributions. Why? Because they'd been using it to pay for every doctor's visit, prescription, and medical expense as they occurred. When I showed them what their HSA could have grown to had they invested those contributions instead, potentially over $150,000, they were shocked. And that's just the beginning of the opportunity they were missing. Here's the HSA strategy we tell our clients to consider. First, contribute the maximum allowed each year. For 2025, that's $4,300 for individuals and $8,550 for families, with an additional $1,000 catch-up contribution if you're 55 or older. Keep in mind that any employer contributions count toward these annual limits. Second, pay for current medical expenses out of your pocket, not from your HSA. Third, invest your HSA contributions in growth-oriented investments appropriate for your risk tolerance, just as you would with your IRA or 401k. Fourth, save all your medical receipts meticulously. And finally, this is the key insight. Let your HSA grow untouched until retirement, when healthcare costs typically increase and your tax situation may be even more complex. Let's look at some of the numbers. If you're a couple maxing out family contributions at $8,550 per year starting at age 50, and you achieve a hypothetical 7% annual return, By age 65, your HSA could grow to over $214,000. That's a significant tax-free resource dedicated solely to one of retirement's biggest expenses. Remember that this is an illustrative example and actual investment performance will vary, but the strategy gets even better. Here's where the HSA reveals its true power for high net worth investors. Many people don't realize that there's no time limit on when you must reimburse yourself for qualified medical expenses. Let me repeat that because it's crucial. There is no time limit on when you can reimburse yourself for qualified medical expenses using HSA funds. This means you can pay for a medical expense today, save the receipt, and reimburse yourself from your HSA 10, 15, or even 20 years later, letting your HSA investments grow tax-free in the meantime. Just remember that if you reimburse yourself for non-medical expenses before age 65, the distribution is not only taxable, but also subject to a hefty 20% penalty. And while reimbursed amounts become effectively unrestricted cash, it's crucial to keep those receipts in case of an audit. Let me show you how transformative this strategy can be with another fictional client example. Richard and Catherine came to me with a common concern. They had built substantial wealth, about $5 million in investable assets, but were worried about how rising healthcare costs might impact their retirement and the legacy they hoped to leave their grandchildren. Now, when we reviewed their expenses, we discovered they'd spent approximately $120,000 on qualified medical costs over the previous 12 years, all paid from after-tax dollars. Meanwhile, they had been maximizing HSA contributions, but using the funds for current expenses. We immediately changed their approach. They began documenting every qualified medical expense while paying out of pocket, and we established an investment strategy for their HSA. The receipts they'd already accumulated essentially gave them access to $120,000 in tax-free money they could withdraw from their HSA at any time for any purpose. Think about that. $120,000 they could use completely tax-free for anything, not just medical expenses. Because they'd already incurred those costs and paid them from other sources, these HSA reimbursements become effectively unrestricted. This strategy essentially transforms your HSA into a supplemental tax-free retirement account. And for many of our clients with high cash flow, this approach can be worth several $100,000 in tax savings during retirement. Now, hit the like button if you're starting to see why I call this the most underused tax break for wealthy investors. And by the way, leave a comment if you're already using an HSA or if this strategy happens to be new to you. Now, let's discuss something that makes the HSA particularly valuable for wealth preservation and legacy planning, an aspect that gets almost no attention in typical financial planning circles. As you know, RMDs, required minimum distributions, force you to withdraw money from your traditional retirement accounts after age 73, whether you need the money or not. These mandatory withdrawals can push you into higher tax brackets and increase your Medicare premiums through IRMA surcharges. But here's something remarkable about HSAs. They have no required minimum distributions during your lifetime. None. You can let your HSA grow untouched throughout your entire retirement if you so choose. For wealthy retirees concerned about tax efficiency, this creates a strategic opportunity to structure your retirement withdrawals in the most tax advantageous way possible. Now, consider William, another fictional retired executive with $4.2 million across various accounts. At 73, he faced substantial RMDs from his IRA that would push his income well into the 32% tax bracket, despite not needing the additional income. By incorporating a substantial HSA into his retirement strategy years earlier, he gained flexibility. While he still had to take his IRA distributions, he could offset some of his medical expenses with tax-free HSA withdrawals rather than using taxable IRA money. Even more significantly, he documented over $200,000 in medical expenses over the previous 2 decades, giving him access to that amount tax-free from his HSA whenever needed, which could be strategically timed during high-income years to minimize his overall tax burden. Now, I want to address a limitation of HSAs. They don't enjoy the same advantageous inheritance rules as Roth IRAs. When you pass away, if your spouse is the beneficiary, they can continue to treat the HSA as their own. But for non-spouse beneficiaries, the account becomes fully taxable upon your death. There is one important exception worth noting. Non-spouse heirs can offset the taxable inclusion by paying the decedent's qualified medical expenses within 1 year of death. This estate treatment actually presents a strategic opportunity for wealth transfer. Use your HSA funds during your lifetime for qualified expenses or reimbursements, allowing you to preserve and potentially pass more of your other assets to your heirs. Now, before you rush to implement this strategy, there is an important caveat. Not everyone qualifies for an HSA. You must be enrolled in a high deductible health plan, or what we call an HDHP, to contribute. For 2025, that means a health plan with a deductible of at least $1,650 for individual coverage or $3,300 for family coverage. The plan must also have maximum out-of-pocket limits of $8,300 for individuals or $16,600 for families. If you're on Medicare, unfortunately, you can no longer contribute to an HSA. This makes it essential to maximize your HSA strategy before age 65. For many of our clients nearing retirement, the question becomes, is it worth switching to a high deductible health plan just to access an HSA? The answer often comes down to healthcare utilization and risk assessment. If you're generally healthy and primarily visiting doctors for routine care, a high deductible plan paired with HSA contributions frequently makes mathematical sense, especially when considering the long-term tax advantages. However, if you have chronic conditions requiring frequent care or expensive medications, the higher out-of-pocket costs might outweigh the tax benefits of an HSA. This is where personalized analysis becomes crucial. At Covenant Wealth Advisors, we run the numbers for each client's specific situation, weighing healthcare needs against tax advantages to determine the optimal approach. For many of our clients with substantial assets, the math overwhelmingly favors maximizing HSA contributions whenever possible, even if it means paying somewhat higher out-of-pocket costs in the short term. So let's walk through the practical steps to implement this HSA strategy. First, if you qualify, open an HSA with a provider that offers robust investment options. Not all HSAs are created equal, and many default to cash or low yield investments. Look for providers offering low-cost index funds or ETFs. Secondly, automate your contributions to reach the annual maximum. For 2025, that's $8,550 for families, plus catch-up contributions if applicable. Remember that both your contributions and any employer contributions count toward this limit. Third, establish a system for tracking and storing medical receipts. This could be as simple as a dedicated folder in your email or a digital scanning app. For example, I personally use TurboScan, which can be downloaded from the App Store. The key is consistency. Document everything, no matter how small. Even copays and over-the-counter medications can qualify with the doctor's recommendation. And fourth, develop an investment strategy appropriate for your time horizon. Since this money may remain invested for decades, consider growth-oriented options balanced with your overall portfolio strategy. Now, let me share a real implementation mistake I've seen way too often. For example, Barbara and Gerald came to me after attempting to self-manage their retirement strategy. They had opened an HSA and were making regular contributions. But when I reviewed their statements, I discovered a critical error. Their HSA was sitting entirely in cash, earning minimal interest. Over the 7 years they've been contributing, this oversight had potentially cost them tens of thousands of dollars in growth. We immediately restructured their HSA investments to align with their long-term goals. But those early years of compound growth were unfortunately lost. This highlights a crucial point. An HSA is not just a savings account. It's an investment vehicle. Treat it with the same strategic consideration you give to your other retirement accounts. Now, if you're finding value in this strategy, please take a second to hit the like button and subscribe to our channel for more tax-efficient retirement strategies. The true power of an HSA emerges when it's integrated into your comprehensive retirement strategy. For my clients with $1 million or more in assets, an HSA becomes one piece of a sophisticated tax diversification approach. Think of your retirement accounts as existing in three tax categories. Tax-deferred accounts like traditional IRAs and 401ks, where you'll pay ordinary income tax on withdrawals, tax-free accounts like Roth IRAs, where qualified withdrawals incur no tax, and taxable accounts like brokerage accounts, where you're subject to capital gains taxes. An HSA creates really a fourth category, an account that combines tax-deductible contributions with tax-free withdrawals for qualified expenses or reimbursements. This unique position makes it invaluable for tax optimization. Let me illustrate this with Elizabeth, a retired physician with $2.8 million in retirement assets. When we began working together, she had a significant imbalance in her tax diversification. Almost 85% of her portfolio was in tax-deferred accounts. This meant she faced substantial RMDs and tax liability in retirement. While we implemented several strategies to address this, her HSA became a critical component of our approach. Over the following years, we maximized her HSA contributions while documenting all medical expenses, but paying them from her taxable account. This effectively converted taxable money into potentially tax-free distributions later in retirement, a remarkably efficient transformation. Now, for many wealthy retirees, the optimal withdrawal sequence in retirement typically depends on your personal tax situation. For some, it may involve taking from taxable accounts first, then tax-deferred accounts to satisfy RMDs, followed by tax-free accounts. For others, it may involve maxing out lower tax brackets with tax-deferred account withdrawals first, then topping off the income need from taxable accounts. Regardless, an HSA adds nuance to any strategy. Since you can reimburse yourself for prior medical expenses at any time, HSA reimbursements become a flexible tool to manage your tax bracket in any given year. Having high medical costs one year? Use your HSA directly. Need to stay below a certain income threshold to avoid Medicare premium increases? Strategic HSA reimbursements can help manage your adjusted gross income. Now, let's put all these strategies together and examine the potential long-term impact for a couple currently in their 50s with significant retirement assets. Now, Michael and Jennifer are both 52, have a combined income of $375,000, and have accumulated approximately $2.2 million in retirement assets. They're both in good health and covered under a family high deductible health plan. If they implement the HSA strategy we've discussed today, maximizing annual contributions, investing the funds for growth, paying medical expenses out of pocket, and meticulously tracking those expenses, here's what the next 30 years could look like for them. By contributing $8,550 annually, plus catch-up contributions when eligible, and achieving a hypothetical 7% average annual return, their HSA could grow to approximately $199,040 by age 65. Keep in mind that these are illustrative figures, and actual investment performance will certainly vary. Now, if they continue to pay medical expenses out of pocket, which for a healthy couple might average $12,000 annually in today's dollars, they could accumulate around $216,000 in documented reimbursable expenses by age 70. This creates a remarkable situation. By age 70, they would have over $279,164 in their HSA, growing tax-free with no required minimum distributions. Meanwhile, they would have documented enough medical expenses to potentially withdraw over half that amount completely tax-free at any time, for any purpose. The tax savings on $216,000 of tax-free withdrawals, assuming a 32% federal and 5.75% state tax rate, would be approximately $81,540. And that's just the beginning. The remaining HSA balance could continue growing tax-free to cover increasingly expensive healthcare costs in their later. Medicare premiums, long-term care expenses, and other qualified costs could be paid tax-free from the account. When we model the tax savings over their lifetime, combining the tax deduction on contributions, tax-free growth, tax-free qualified withdrawals, and potential avoidance of the Medicare surtax, the total benefit can well exceed $81,540 for high-income professionals and executives. That's $81,450 or more than that stays in your family's hands rather than going to the IRS, all from a strategy that many financial advisors barely mention. Now, as we've seen today, an HSA offers unique advantages that make it possibly the most powerful tax advantage account available to high income or wealthy investors. Triple tax advantages with tax deductible contributions, tax-free growth, and tax-free qualified withdrawals. The ability to invest and grow your HSA for decades without touching it. The flexibility to reimburse yourself for medical expenses years or even decades after they occur. No required minimum distributions during your lifetime. And the potential for six-figure tax savings when properly integrated into your comprehensive retirement strategy. But remember, this isn't just about tax optimization or maximizing account balances. It's about what those savings mean for your life and legacy. It's about having more resources to enjoy the retirement you worked so hard to achieve. It's about reducing worry over healthcare costs that keep many retirees awake at night. And it's about preserving more of your wealth to leave to children, grandchildren, or the causes you care deeply about. Every dollar saved in taxes is a dollar that stays within your family, serving your values and priorities rather than disappearing into government coffers. Now, if you found value in this HSA strategy, I'd like to offer you something special. We've created a comprehensive retirement kit that includes 15 retirement cheat sheets to help you avoid costly mistakes in retirement. To download your free copies, just visit covenantwealthadvisors.com or just click the link in the description below. And if you're approaching retirement with $1 million or more in investable assets and you want to ensure your retirement strategy is optimized for tax efficiency and wealth preservation, I invite you to schedule a free retirement assessment with one of our senior financial advisors. During this conversation, we'll review your current retirement strategy, identify potential tax saving opportunities, and help you determine if your portfolio is properly structured to support your retirement lifestyle and legacy goals. Thank you for spending this time with me today. I'm Mark Fonville, and at Covenant Wealth Advisors, we're committed to helping successful families retire with confidence and clarity. I'll see you in the next video. Thanks so much.